Holy moly, what a day. News came out today that a hedge fund had too many loans that weren't worth enough, and the banks called them up and said, you gotta pay us back now. And so this big hedge fund company had huge stakes in Viacom, in Disney, and in Discovery Communications. That caused a lot of selling pressure, and these companies have all dropped a lot in value while the market sort of stayed about even. Discovery Communication, that was up, I think, like 200% in the last 12 months. And then since March 24th to today, which is March 29th, which is all of like 24, like all of 5 days, right? It's gone down like 50%. And then same with Viacom, also down almost 50%. Disney's not too bad, it's only down about 10%. So big news. And I also want to explain why this is not great news for individual investors. If you're an individual investor and you're holding on to some of these companies, I want to explain why, it's not good. Okay, if you're an individual investor, you buy shares on the open market when the market's trading. And you see that prices go up and prices go down, and there's a bunch of people trading, especially for some of these big companies, big blue chip companies. There's quite a bit of volume, and you can see a lot that's going on. Well, unfortunately, there's also trades that you'll never see, things that aren't going on behind the scenes, where two private parties are exchanging shares and setting their own prices. And this is exactly what happened when this hedge fund got its call and had to sell a bunch of its assets. You see, the banks had wanted to get rid of these assets, sell them quickly to generate cash so that they wouldn't have to have these bad loans on their books. And so in order to sell them quickly, they did what are called block sales. Block sales are huge, tranches of stock that are sold to other private investors that you'll never see on the open market. You'll never see the volume show up, and you'll never see the prices show up. And those huge blocks are sold at a discount, because who would want to fire sale buy a bunch of stuff unless it was a really good price? So if you're an individual investor, all of a sudden you've lost transparency. You can't even see what's really going on when people are buying and selling, shares. And I don't know what the volume is of these private sales of shares that were going on, but selling shares for discounted prices. And you think, oh, you know exactly what the price of Disney or Viacom or CBS is, and you don't. And that's one of the big reasons that you see such these huge drop-offs, because the market started to become aware of these private sales. They didn't know how to price them, and stuff started to drop. Also, some of the banks actually had to sell some of their shares on the open market. And some of the block sales that went to other private parties at a discount, the private party that would then turn around and just sell them on the market, right, to make a quick buck, right? Oh, you're going to sell me the stock for a 20% discount? Sure, I'll just go sell it on the market right now. And even if it goes down by 10%, I'm still making some money. So all that stuff's going on behind the scenes, and as an individual investor, you have no clue, and now all you see 5 days later is the stock has plummeted. So the next thing is, what does it mean for you, and what are you supposed to do about it? These big block sales behind the scenes are not good news, because it means that people have shares that weren't even traded on the market, and now they're going to need to do something with them. Sometimes people buying these block shares may feel that they're a good long-term investment and they'll hold on to it. But most of the time, people that are taking these block shares are just looking to turn them around and sell them again to exit out and make a profit on them. And what that means is there's more selling pressure. People have stuff to sell. And you didn't even realize that they were in the market to begin with, and all of a sudden now they're on the market. So over the next couple weeks, even at these low prices, I could just see as the shares start to go up in price, more selling comes in and just suppresses the stock price. That means that Disney, Viacom, Discovery, their stock prices are probably going to trade in a range for a while. You're not going to see them break out. If you're an individual investor and you have a lot of exposure to Disney and Viacom and Discovery Communications, you have a choice to make. First, you need to know what type of investor you are. If you're a long-term investor and you believe that these companies have a bright future, then you should hold on to them because the market will go up and the market will go down. You don't have much control over that. You don't have control over the actions that the other people take, but you do have control over which stocks that you're holding onto. And so if you believe that these companies are good ones, you should just continue to hold on to them. Now, on the other hand, if you take a company like Discovery, whose stock price I think is up 200%, something like that, in the last 12 months, you may have bought that as a speculative play, thinking, oh, the stock will keep going up. You may have been doing some options activities on it. And now all of a sudden you find that the stock has dropped in half. So now what was a 200% gain is now only a 100% gain. What should you do? Well, typically you should look at your overall portfolio and see how much exposure you have. So if you're overweighted in Discovery, that is, if your Discovery is taking up a majority of your portfolio, you should sell it and rebalance that portfolio. It would be good if you had done that before, but now that the stock price is down so much, it's probably not a big portion of your portfolio anymore because the share price has just dropped. However, you may have lost faith in it and you may just want to get out. If you want to get out, then here's some option trades that I would recommend for exiting your stock that you're holding. So the first thing that you could do is you could just simply sell your stock outright. You could sell a little bit every day. I mean, the price has already dropped like 50%, so I wouldn't expect it to drop a lot more. It could probably only go up. Sell a little bit every day or sell a little bit every week until you finally unravel it. That's a pretty good strategy. I wouldn't panic and sell everything at once because, like I mentioned, it's dropped. In the case of Discovery or Viacom, they've dropped so much already, I can't see them going down much more. Then if you sell your shares, now you have cash, and then you can decide what you want to do with this new cash, whether you want to buy something new or, maybe invest and save it in your checking or savings account or put it towards your retirement or kids' college education, pay off your mortgage, anything like that. Now, if you sold off your stock because you needed the cash, or you were sold off your stock because you really don't think it's a good investment anymore and you don't want to hold a bad investment, but you still think that the stock might go up in the future, you can do something. You can buy a call option. So you sell your, say, Discovery shares, and then you would buy a call option pretty far out, say like 6 months, and you would buy it pretty close to the current strike price. And then if the stock went up, right, you could sell your call option and make some money. Or if the stock went up, you could actually buy back, your Discovery shares at this lower discounted price that you got from your call. This is a way of selling your shares but still participating in future upside without having to spend all your money. The advantage of this is, since you have this, the option doesn't cost as much as the underlying share, you have extra cash. And with that extra cash, you can diversify. You can go and invest in other things. The bad part about this strategy, selling first and then buying the option, is you're paying the taxes or you're taking the loss, right? Whatever it is. And you have to take that short or long-term capital gains right up front, and then the option is separate because it's 6 months down the road later. That's the bad part about that particular strategy. If you didn't want to sell your shares because of perhaps tax consequences, or maybe you still really believed in the company, what can you do? Well, one of the things you could do is you could start selling covered calls. Since you have the actual shares and the price is probably going to trade in a range for a while, you could actually sell a call option that's dated 2, 3, or 4 weeks out at a price that's, maybe 5%, 10% above the current market price. And what this would do is allow you to collect some money while the stock is sort of sitting there at this depressed level and will probably remain at this depressed level for some time. So the good part of this is, you're kind of getting an income stream, off of this stock. The stock did so poorly and now, you're able to get some money back off of it. There's actually 2 bad parts to this. right? The first bad part is, pretty simply that if the stock goes up by quite a bit, you're forced to sell. So if the stock goes and doubles again, you're not going to participate in all that upside. You're going to sell the stock, pretty 5%, 10% after it goes up, depending what the strike price is for your call option. So that could be annoying because you're like, oh, I could have made a bunch of money back and now I just sold it early. The second bad thing is, if you have bad stocks, if stocks perform poorly, you really don't want to invest in them again, right? You don't want to put more money into them. It's called watering the weeds, right? Your best performers, your top performers in your portfolio are the ones that you want to add to. You don't want to add to the stocks that are doing poorly. That's a recipe for disaster because stocks that have done poorly will probably continue to do poorly. Stocks that have done great will probably continue to do great. And I think it's one of the biggest mistakes that investors can make if they're investing in individual stocks is they try to sort of average out their portfolio and, re-up some of the positions that lost a bunch. And all they do is they sell their winners and buy the losers, which is not a great way of making money at all. So if you decide to sell a call option, you're kind of stuck with a stock waiting for the call option to expire. You're kind of stuck sitting there. Sure, you may get some money for staying in the market and just staying with that stock, but you have to ask yourself, is it worth it? Let's get specific. So if you're holding Discovery, by the way, I don't own any Discovery stock at all. Today, March 29th, it closed at $41.23. If you wanted to hold on to your stock and sell a covered call, you could look at the April 18th calls. There's one at 45, which is a little less than 10% above the current price. And for 45, the strike price of 45 expiring April 18th, you would get $2.37. Now, this is $2.37 per share, and also each option that you sell, remember, is 100 shares. So you would instantly get $237. So if the stock stayed below $45, by April 18th, if it was less than $45, then you would keep that $237 of income, and it would be taxed as income. If, on the other hand, the stock on April 18th was above 45, then the option would be called, and your 100 shares of Discovery stock would be sold at 45. Now, you would essentially be selling it at 45 plus the $2.37 premium that you got, so that's $47.37. So if the stock was $47.37 or lower, you'd be making money. If it was more than $47.37, then you'd be losing out on potential profits. If you've held your Discovery stock for more than a year as of April 18th and you're making a gain on it, you should be able to take your long-term capital gains on both the sale of the stock, which is 45, and on the profits that you make from the option call, which is $2.37. There are some peculiarities that happen with these option calls and the treatment of capital gains, so you want to make sure that you check with a tax advisor to make sure you do it right. But there is the possibility of taking long-term capital gains on both the option, money that you get from the option, and the actual sale of the stock, which is something people don't know, so it's something that you should look into. If you wanted to sell your shares and participate in future gains, then what you could do is sell your shares now and then look to October 15th and look at the $40 strike price, and you could buy a call option there. As of aftermarket on the 29th, that price was $7.80 per share. So if you bought one call option dated to expire October 15th, remember one call option is 100 shares, you would pay $780 for that. And then what that would allow you to do is if the stock went above $40, then you could start to sell that option at a profit. Now remember, you paid $7.80 per share for that option, so actually on October 15th, in order to make money, the stock has to be $47.80 or higher. If it's less than that, you won't be making any money on it. So you can sell your call option before October 15th, or if the call option was going to go through, that is, if the stock price was going to be above $40 on October 15th, you could just let it go through and you could buy the shares at buy the Discovery shares at $40, and you could hold on to them and sell them at a later date, or just turn around and sell them next day, whatever you want to do with it. So that's the other option, to sell your shares now and to buy a call option for October 15th. Like I mentioned earlier, I don't hold any Viacom or Disney or Discovery Communications stock. But it just goes to show you what crazy things can happen, even though they have nothing to do with the actual companies, right? It's just something that happened to an investor who happened to hold a lot of the shares, and that forced a bunch of selling to occur. Now, you could go back and say, oh, but Viacom had a debt offering, and that debt offering, suppressed the stock price. Yeah, that's true, but also this hedge fund that had a bunch of losses in Chinese internet companies too, and those Chinese internet companies were going down because there was rumors that the U.S. might not want to list them on U.S. stock exchanges, that the U.S. government might stop them from listing. So it was really this sort of bizarre Rube Goldberg knock-on effect of stocks in foreign countries affecting, good blue chip companies here. And it's just really tough, right, if you're an individual investor. And then that's why it's hard sometimes to feel like you're really doing a good job when you're managing your investments. And that's why I think the only way to really do it is to find good companies, you buy at a fair price, and you hold them for a long time. And of course, the key is that those companies continue to grow, and they certainly don't go out of business. So, I'm a big long-term holder fan, not a short-term trading fan. And like I said before, the market can go up and the market can go down. People can sell stuff. You don't have any control over that. What you do have control over is the stocks that you own. And if you believe that they're good companies and they're going to be part of the future, then you can hold on to them with conviction. If you are just doing it as part of a speculative trade and the bottom falls out, you have a tendency to panic and you need to sell and try to invest in something else to try to make your money back. So I would say be a long-term holder. Invest in companies that you're going to hold on to for a long time.